In this video, we're going to concentrate a little bit more on how managers make decisions, right? What processes do they go through? So the first issue that we have is what's referred to as the agency problem. Typically, managers seem to act more in their own best interests and not on behalf of the owners or the stockholders. This is what's referred to as the agency problem. So if you put this in context of a business, if you're a sole proprietor, is there an agency problem? Well, the question is, if you are the sole proprietor, would you do anything to intentionally damage the company or your wealth? And of course, the answer to that is not. Now, you'll make mistakes, but that's not the same as doing things that have a negative impact on the value of the company. Corporate finance is the set of rules that helps us try to control the behavior of the directors, managers, etc. So it's going to help us control these agency problems. So what should be management's primary objective? And there's lots of discussion of this, right? The primary objective should be shareholder wealth maximization, which translates to maximizing fundamental stock price. So should firms behave ethically? Of course they should. Do they have a responsibility to society at large? Of course they do. Shareholders are obviously members of society. So the question here is, who do managers have a direct responsibility to? It is obviously to the owners of the company. Again, think back to the sole proprietor. Who is that person? Who are they directly responsible to for the well-being of the company itself, its future growth and its profits? Of course, that's the owner of the company, that's the manager. So the objective, there are lots of objectives, but one of the primary objectives is to increase the wealth of shareholders. So how do we do this? One of the aspects that we have to look at is what's referred to as cash flows. So what do we want to do? Of course, we want to try to increase cash flows. Bigger is better. What about the timing? We want to try to get cash sooner rather than later. And with respect to risk, we want to try to find ways to reduce the risk of the company. Increasing cash flows, getting cash flows quicker sooner than later, and trying to find ways to minimize the riskiness of those cash flows all add to the value of the company, which in turn increases the wealth of the owners of the company. And again, I don't want to go back in and not think about other stakeholders. We don't want to do anything that would endanger, on purpose, any other stakeholder, right? So we want to try to make decisions that make as many people happy as we possibly can. Of course, we do know it's very difficult to make everybody happy all at the same time. So when we speak about cash flows, we're talking about specifically free cash flows. These are the cash flows that are available for distribution to all investors, stockholders, and creditors. After the company has paid all the expenses of running the company, after they have purchased all the assets or sold assets that are required to operate the company, both short-term and long-term, what is left over? This is cash that can be used for a variety of things. All of those things are geared towards the investors of the company. So if you are a creditor, this is cash that is available to pay interest or to buy back and retire bonds. If you're an owner of a corporation, whether it's a preferred or a common owner, this is cash that can be used to pay dividends, and it's cash that can be used to repurchase shares of stock as the company desires. The greater the amount of free cash flow, the safer our investors should feel about the prospects of the company. The weighted average cost of capital is the average return required by its investors. And this is a little confusing, I think, until we really, if we try to simplify it, I think it makes life a little bit easier, of course. But thinking about weighted average cost of capital, this is what it costs to finance operations of the company. Where does it come from, right? Who do we pay? This is money that's paid to our investors. So the weighted average cost of capital is affected by capital structure. What's the relationship by the amount of debt and equity that we have in the company? It's impacted by interest rates, risk of the firm, investors' attitude towards risk, anything that has an impact on the economy at large. They're all incorporated into this weighted average cost of capital. So how do we use that? This is kind of a basic formula, right? How do you find the value of a corporation? We need to forecast future cash flows, and then we offset that, find the value of those cash flows, utilizing the weighted average cost of capital. So one question we can have from this formula: how can managers increase the value of the company? Number one, you can make free cash flow bigger. If you increase any of these numbers, the value goes up. If you can bring the numbers back so that earlier times have more cash flows than later times, that is, if you can get the money quicker because of the time value of money, the value of the company grows. In addition, we can find ways to minimize the costs of financing the company. We can find ways to increase the value of the company. By decreasing the weighted average cost of capital, we are in essence reducing the risk of the firm, because the cost of capital is influenced by the desire of investors based on risk. The big picture here, obviously, is how is this stuff all related? Obviously, free cash flow comes from revenues and investing. The weighted average cost of capital comes from decisions about how much debt we have, the market influence on interest rates, etc. So all of this has influence then on this weighted average cost of capital. So how does capital transfer back and forth? We're kind of moving into kind of a financial markets aspect, right? How do we utilize those to get funds? Well, let's talk about the costs in general. In general, how do money get around? Through direct transfer, right? Companies issue commercial paper, right? Companies can actually issue stock directly, right? We can get that through an investment banking house. Different types of financial intermediaries can help us transfer cash flow between savers and borrowers. What are the influences on the cost of money, right? So what do we call this price? It's referred to as the interest rate, but it can be called a lot of things, right? We can talk about the price or cost of equity capital. We can talk about the cost of debt, obviously, is interest, but cost of equity is dividends, capital gains. What kind of factors affect these? Well, they're the ones we've been tossing around here over the last several slides. What are the opportunities of the firm? As opportunities increase, the demand for funds increase, which means the cost goes up. Time preferences for consumption. Investors want to pay sooner rather than later. If we're delaying a return to a future date, investors want to get paid for that delay. There's a variety of risk elements that impact the cost of money, and of course, inflation has a very large influence. So, what kinds of economic conditions affect cost of money? We can look at the Federal Reserve, their monetary policy, increasing, decreasing interest rates, buying and selling of federal debt has impact on the supply and demand of money. We can also look at fiscal policy, right? Actions by the federal government have influence on the cost of money. The actual level of business activity. Are we in a recessionary time or a boom time? And of course, any kind of international trade, we have to have some balance between our trade with foreign entities. If we're working at deficits or surpluses, that can have an impact on the cost of money. So what type of markets are we? Well, a market in general is just a place where we can exchange things. We can exchange physical assets, financial assets. Spot versus future markets. Spot markets are today's markets. Future markets are things in the future, obviously. Money markets and capital markets. Money markets are typically short term, less than a year. Capital markets, anything greater than a year. Primary versus secondary markets. I mean, this is one of the types of markets that, quite frankly, isn't all that important, except we need to understand where the money goes. A primary market, it was in a security when it's sold for the very first time. So the cash goes to the corporation or the entity that's creating the security. Secondary markets is any time a security is traded after the first time. So in that case, the money is exchanged between investors. And again, we talk about that here a little bit, is the primary market and the secondary market. Right? Who gets the money? That's the important aspect of that type of security trade. So if we think about trading procedures, right? What dimensions do we have? Well, basically there's two things. There is a location, right? Most financial trades that we think of have, relatively speaking, a face-to-face kind of transaction. So it can happen between two people. It also can happen via a computer network. So how do we trade, right? So what are those actual trades? What is the process? It's typically in a face-to-face trading, there's something referred to as open outcry. This is where the price has to be physical, it has to be transparent, and you have to know about it, right? It has to be an auction where you yell out, if you will, the price. A dealer's market is typically more of an inventory transaction that happens more on a computerized network. There are a lot of automated trading platforms now that help match orders and execute trades a little bit easier than they have done historically. So what type of orders are there? Essentially, there's two kinds. There's a market order and a limited order. A market order is when you transact as quickly as possible. You call up, you say, I want to buy 100 shares of P&G, and as soon as that order gets to the person selling P&G stock, the trade happens at whatever the price is. A limit order is where we put stipulations on the order, right? So maybe we say, buy it if the price drops to $50 or below in the next 2 hours. So we put some very specific guidelines on exactly how we want the trade to occur. There are all kinds of exchanges. A registered stock exchange is typically a place, but it could be a computerized network. They have to report trades. They provide information, but it's the place, whether it be physical or virtual via computer, where trades actually occur. So there are two basic domestic exchanges, the New York Stock Exchange and the NASDAQ. The New York Stock Exchange is the oldest exchange. Recently, they combined with what used to be called the American Exchange, so now it's just one big exchange. And the NASDAQ has a lot of technological kinds of issues, or technological companies as their issues. And they tend to be a little bit of smaller corporations, but not always. But the NASDAQ is a computerized network. So the New York Stock Exchange listings have a bigger market value, but not a greater number of companies involved. Look forward to talking to you in the next video.